What is the S&P 500 and should you invest in it in 2025? You've probably heard about the S&P 500 everywhere. Your coworker mentions it at lunch, financial news talks about it daily, and every investment app seems to push it. But what exactly is this thing that everyone's obsessing over? If you're sitting there wondering whether you should put your hard-earned money into something you don't fully understand, you're not alone. By the end of this video, you'll know exactly what the S&P 500 is, how it works, and most importantly, whether it deserves a place in your portfolio. Here's the bottom line up front. The S&P 500 might be the closest thing to a set-it-and-forget-it investment that actually works. But before you rush to buy, let's break down what you're really getting into. What exactly is the S&P 500? Think of the S&P 500 as America's corporate Hall of Fame. It's an index that tracks the stock performance of the 500 largest publicly traded companies in the United States. We're talking about household names like Apple, Microsoft, Amazon, Google, and Tesla. But here's what makes it interesting. When you invest in an S&P 500 fund, you're not picking individual stocks. Instead, you're buying a tiny slice of all 500 companies at once. It's like getting a membership to an exclusive club where you automatically own a piece of America's biggest businesses. The index is maintained by S&P Dow Jones Indices, and they have strict criteria for which companies make the cut. A company needs to be worth at least $15.8 billion, be profitable over the last 4 quarters, and meet several other requirements. Companies get kicked out if they no longer qualify, and new ones take their place. How does the S&P 500 actually work? Here's where it gets a bit more complex. The S&P 500 isn't equally weighted, meaning you don't own the same amount of each company. Instead, it's weighted by market capitalization. The bigger the company, the more influence it has on the index's performance. Right now, the top 10 companies make up about 38% of the entire index. That means when Apple has a great day, your S&P 500 investment feels it more than when a smaller company in the index does well. Currently, the biggest players are Apple, around 7% of the index, Microsoft, around 6.5%, Nvidia, around 6.5%, Amazon, around 3.5%, Meta, around 2.5%. Technology companies dominate the index, making up roughly 30% of the total weight. Healthcare is second at about 13%, followed by financials and consumer discretionary. The costs. Why this matters more than you think. One of the biggest advantages of S&P 500 investing is the cost, or lack thereof. Most S&P 500 index funds charge expense ratios between 0.03% and 0.09% annually. To put that in perspective, if you invest $10,000, you'll pay between $3 and $9 per year in fees. Compare that to actively managed funds that often charge 1% to 2% annually, and you're looking at $100 to $200 per year on the same investment. Over decades, this difference compounds dramatically. Those seemingly small fees can cost you tens of thousands of dollars in lost returns over a lifetime of investing. Historical performance, what the numbers actually show. Let's talk about what the S&P 500 has actually delivered. Over the past 50 years, the index has averaged about 10% annual returns. That includes the dot-com crash, the 2008 financial crisis, the COVID pandemic, and every other market disaster along the way. More recently, 2023 delivered 24.2% returns, and 2024 came in at 23.3%. But don't let those numbers fool you. The market doesn't deliver consistent returns year after year. Some years you'll see gains of 30% or more. Other years you'll lose 20% or more. The key is time. If you had invested in the S&P 500 at any point in history and held for 20 years, you would have made money. That's a pretty compelling track record. The pros. Why everyone recommends it. Instant diversification. With one purchase, you own pieces of 500 different companies across multiple industries. If one company fails, it's unlikely to tank your entire investment. Low maintenance. You don't need to research individual stocks, follow earnings reports, or worry about management changes. The index automatically adjusts as companies grow or shrink. Historically reliable. Over long periods, the S&P 500 has consistently outperformed most actively managed funds, bonds, and other investment options. Liquidity. You can buy or sell S&P 500 funds any trading day. Your money isn't locked up. Tax efficiency. Index funds generate fewer taxable events than actively managed funds, meaning you keep more of your returns. The cons. What they don't always tell you. No guarantee of future performance. Past results don't guarantee future returns. Just because it worked for 50 years doesn't mean it will work for the next 50. Market risk. When the market crashes, the S&P 500 crashes with it. In 2008, it dropped 37%. In early 2020, it fell 34% in just over a month. Concentration risk. With big tech companies dominating the index, you're making a bigger bet on the technology sector than you might realize. No control. You can't influence which companies are in the index or how much weight they carry. Currency and inflation. Risk. Your returns can be eroded by inflation, and all returns are in dollar terms. Should you invest in the S&P 500 in 2025? Here's my honest assessment. The S&P 500 makes sense for most people as a core holding, but it's not perfect for everyone. You should consider it if you want broad market exposure without picking individual stocks. You're investing for at least 5 to 10 years. You want low fees and low maintenance. You believe in the long-term growth of the American economy. You're looking for a simple, straightforward investment approach. You might want to skip it if you need your money within the next few years. You can't handle seeing your investment value swing up and down. You want to actively manage your investments. You're looking for income and dividends rather than growth. You want to avoid concentration in large U.S. companies. How to actually invest in the S&P 500. You can't directly buy the S&P 500. You need to buy a fund that tracks it. Think of these funds as baskets that hold all 500 stocks in the same proportions as the index. Here are your main options. ETFs, exchange-traded funds. These are the most popular choice. SPY is the oldest and most liquid, but it has slightly higher fees. IVV and VOO are newer and have lower expense ratios. These funds trade like individual stocks throughout the day, so you can buy and sell anytime the market is open. Mutual funds, like Vanguard's VFIAX or Fidelity's FXAIX. These are priced once per day after markets close. You can't trade them during market hours, but they often have features like automatic dividend reinvestment and the ability to invest exact dollar amounts rather than whole shares. 401k options. Most employer retirement plans offer S&P 500 funds. These might have different names or slightly different expense ratios, but they track the same index. If your employer offers matching, this is often the best place to start. Most major brokerages offer these funds, and many now allow you to invest with no minimum and no transaction fees. Fidelity, Vanguard, Charles Schwab, and others have driven fees to near zero in competition for your business. Here's a practical tip. If you're just starting out, pick any low-cost S&P 500 fund from a reputable provider and start investing regularly. The difference between a 0.03% expense ratio and a 0.09% expense ratio matters much less than the difference between investing and not investing at all. You can also set up automatic investments to dollar cost average into the fund. This means investing the same amount every month regardless of whether the market is up or down. It's a simple way to remove emotion and timing from your investment decisions. The bottom line, the S&P 500 isn't a magic wealth-building machine, but it's about as close as you can get to a simple, effective long-term investment strategy. It's not going to make you rich overnight, but it's historically been one of the most reliable ways to build wealth over time. The key is understanding what you're buying. A broad bet on American corporate success, with all the ups and downs that come with it. You're betting that American companies will continue to innovate, adapt, and grow over the long term. Given the track record of American capitalism, that's not a bad bet. But let's be realistic about expectations. The days of 20% plus annual returns, like we saw in 2023 and 2024, aren't sustainable forever. More realistic long-term expectations are in the 7 to 10% range, and that includes years where you'll lose money. The S&P 500 works best as part of a broader financial plan. It's not a get-rich-quick scheme, and it's not appropriate for money you'll need in the short term. But for long-term wealth building, it's hard to find a simpler, more cost-effective approach. Remember, investing is personal. Your age, income, goals, risk tolerance, and time horizon all matter. The S&P 500 might be right for your situation, or it might not. But at least now you know what it is, how it works, and what you're signing up for. If you can handle the volatility and you're investing for the long haul, it's hard to argue against having the S&P 500 as a cornerstone of your investment portfolio. Just remember that successful investing is more about time than timing, more about consistency than perfection. The most important step is to start. Whether you begin with $50 a month or $500 a month, the key is developing the habit of regular investing and letting compound growth work for you over time. The second most important step is to stay invested through the inevitable ups and downs. What do you think? Are you ready to become a part owner of America's 500 largest companies? Have you had good or bad experiences with S&P 500 investing? Let me know in the comments. And if this helped clarify things for you, hit that like button and subscribe for more straightforward investment advice that cuts through the noise and gives you actionable information you can actually use.